Welcome to our CFP Exam Prep podcast. Today we're diving into an important tax concept that frequently appears on the exam: involuntary conversions under Section 1033. This tax provision can significantly impact your client's tax situations when they face unexpected property losses. Let's break down what constitutes an involuntary conversion. It occurs when property is destroyed, stolen, condemned, or disposed of under the threat of condemnation. The key aspect that candidates often misunderstand is that the disposition must be beyond the taxpayer's control. For example, if a client's rental property is destroyed by a hurricane or taken by the government through eminent domain, these would qualify as involuntary conversions. The magic of Section 1033 lies in its tax deferral opportunity. When your client receives proceeds from insurance or a condemnation award, they can defer recognizing the gain if they reinvest those proceeds in similar or related use property. This replacement must occur within a specific time frame. For most situations, the replacement period is 2 years from the end of the tax year in which the gain was realized. However, when dealing with condemnations of real property used in a trade or business, the timeline extends to 3 years. Here's a practical example that often trips up exam takers. Let's say your client's commercial building worth $500,000 is destroyed by a fire. The insurance company pays $700,000. Without Section 1033, your client would need to recognize a $200,000 gain. However, if they reinvest the entire $700,000 in a similar property within 2 years, they can defer the entire gain. The basis in the new property would be adjusted to $500,000, preserving the potential gain for future recognition. A common mistake students make on the exam is confusing Section 1033 with Section 1031 like-kind exchanges. While both provide tax deferral opportunities, Section 1033 is specifically for involuntary conversions and offers more flexibility in terms of replacement property requirements. The replacement property doesn't need to be exactly the same type, but it must be similar or related in service or use to the converted property. Another crucial point that exam questions often test is partial reinvestment scenarios. If your client only reinvests part of the proceeds, they must recognize gain proportionally. For instance, if they receive $700,000 but only reinvest $600,000, they must recognize a portion of the gain immediately. Watch out for questions about the election requirements. Unlike many other tax provisions, Section 1033 treatment is the default. Your client must elect out if they want to recognize the gain immediately, not elect in to defer it. This detail frequently appears as a trick answer choice on the exam. When studying this topic, focus on understanding the qualification criteria, replacement period requirements, and basis calculations. The exam commonly presents scenarios where you'll need to determine whether a specific situation qualifies for Section 1033 treatment and calculate the deferred or recognized gain amounts. Remember that timing is critical. The clock starts ticking from the end of the tax year in which the gain is realized, not from the date of conversion. This detail often appears in complex exam questions where you need to determine whether a client's replacement property purchase falls within the allowable window. By mastering these aspects of Section 1033, you'll be well prepared to handle related questions on the CFP exam and provide valuable guidance to future clients facing involuntary conversion situations.